he's got these short-term cycles and longer-term cycles. The tech bubble in 2000, we had the 2007 financial crash, the peak there, COVID, 2019, 2020. And the next cycle high is this year, 2026. And it says we should be seeing weakness until 2032.
Oof.
So we're in for, all of my analysis has been pointing to a major cycle coming to an end. The question is, when does it actually stall and roll over? And this Benner cycle, not saying it's going to happen, but it's definitely nice to have to see something. Yeah, well, there's a lot going on, but there's no doubt the best asset right now is the silver, for more or less the silver ETF or the price of silver. We've seen silver skyrocket higher based on our BAN, which is our best asset now strategy. As you mentioned, we had a new trigger in silver, in SLV. And of course, we're seeing this thing rip to the upside, just screaming, breaking out as you and I are speaking today. And I mean, this is a high momentum move. Really, metals is where all the money is flowing. The stock market has been dormant and chopping sideways for a couple of months, not really getting a lot of traction. And so all the focus has been on metals. And pretty much, if you look at our hot list here on the left-hand side, silver's number one, copper's number two, silver miners, then base metal miners and GDX, lithium. So we definitely have, the resource space is on fire. It's breaking out. We got massive volatility in silver, which it's a bit of a warning sign. I'm going to flip over to the futures chart here, the daily chart of silver. And this type of volatility that we're seeing over the past, week and a half is pretty extreme. When we have these 10 to 12% back and forth days, that is a sign that a lot of people are moving in. There's big bouts of buying and selling, and volatility tells us that something big is about to happen. Now, usually when we see elevated volume and volatility, it usually means a turning point is coming. But at this point, we're still in a high momentum phase to the upside. All the moving averages are sloping upwards. And this is a high momentum move. We could actually see silver have a very big move based on the Fibonacci theory. We have a huge upside target in silver based on this rally that points to roughly $106 an ounce if this was to pop and explode. And that means we could actually see this happen within really just a couple of weeks. I think we were in this very close to this parabolic phase in the stock market where we start to see things really take off and rally. And as you and I have kind of shared before, when we look at the type of price action, I believe gold and silver are obviously in a screaming bull market, but I do think we're coming into this market euphoric phase. I think we're going to see one big push where silver goes from where it is right now, potentially busts through that $100 per ounce mark. Gold probably flies up to 51, 52. Who knows where the peak is, but we're definitely in this territory where volatility is here. We could have 10% moves easily on a daily basis. And, this is where all the money is really focused. It's not just like North America, kind of like miners are more of a speculative play. It is somewhat of a focused group of investors. Precious metals, as I've been mentioning on here, you and I have talked about it for many months. I like physical metals better because they're not part of the stock market and they're more global. We're seeing the whole world participate in precious metals. And of course, it's such a tiny asset, market size. So it moves very easily. So we're in this, I think, this last push to the upside in precious metals. But the question is, where is the peak? And when things go parabolic and have these bubble phases and the whole world moves in, you don't really know where that peak is going to be. But the next critical upside target or major target is $106 an ounce for silver, which is pretty exciting.
Silver's recent price action has been anything but calm. Wide daily swings and unusually high trading volume point to a market under stress, but also opportunity. Historically, this level of volatility appears during transitional moments, when participation accelerates and conviction rises. While extreme volatility often precedes turning points, the current structure still favors continuation rather than collapse. Trend indicators remain aligned upward, reinforcing the idea that silver is in an advanced expansion phase. Using long-term technical projections, some scenarios suggest prices could stretch far beyond historical norms. Whether or not those levels are reached, the message is clear. Silver is no longer moving quietly.
Yeah, I mean, not much has changed from our last monthly view of gold. The same targets, the same everything is still presenting itself, where this big run up and push is still pointing to that $5,100, $5,200 per ounce level for gold, which at the current price, that's about a 15% move from where we are right now. So the big picture hasn't changed. And I mean, I think that's the key is you got to stick with the underlying longer term trend if you're an investor and you don't want to get shaken out. There's been some pretty big volatility, some pretty big down days in gold, but it's really kind of most of these moves have been news driven. Obviously, we've seen the margin requirements change on silver a couple of times. That created a bout of selling in the precious metal space, which so many people, argue that it's markets are manipulated and they're getting hammered down. But really, to me, it's a margin call, margin requirement. If margins go up, there's going to be a bunch of margin calls. It's going to force a bunch of people to have to sell, and that drives the price down. And of course, usually, we saw it across the board in gold and platinum and palladium. And whoever's long silver, for example, probably has gold, probably has platinum or palladium, or a good group of them. And so they have to liquidate, trim their portfolios and raise cash to meet margin requirements. So these sharp pullbacks are nothing more than just a news driven event you could say is trying to shake the market out, but really, the COMEX trying to balance things and try and keep some margin and investors a little bit protected if the SEC or the governments really actually are there to protect the people. But anyway, gold is definitely still pointing to higher pricing. And I think it's going to continue to grind higher. And I think it's just a matter of time before it picks up speed and hits all-time highs again. And then we start to, I think this next run could be very, very exciting. 51, 5,200 is the next target, but who knows where the peak could be. We could see this, go dramatically higher. It's just a matter of how things unfold. And I just measure the markets one wave, one move at a time. A lot of people will start stacking up, a 200% move or 300% move based on Fibonacci or other patterns. I don't do that because they're not very accurate. I like to just go one leg at a time and you stay invested because you follow the underlying trend. And that's kind of what I think most precious metal investors do. They buy and they hold it and they stick with the underlying trend here.
This rally is not confined to North American traders or ETF flows. Demand for physical precious metals is rising globally, particularly in regions where financial instruments are limited or mistrusted. Gold and silver are increasingly treated as monetary assets rather than speculative trades. Their relatively small market size amplifies price movement once capital flows accelerate. This explains why metals can move faster than equities despite fewer participants. As inflation risks, currency instability, and geopolitical uncertainty persist, physical ownership has become more attractive. In this environment, metals respond less to headlines and more to long-term capital preservation needs, creating sustained upward pressure.
Yeah, whenever we look at this market, I mean, there's been a series of, 20% rallies. There's another one here. There's another one here. There's another one here. I mean, it's just never ending 20+% rallies, right? And from kind of the middle of this range to the next one,
which is 5,100 or 5,200.
I don't know where it is, but it's probably pretty darn close. Let's just grab in the middle here and go up. Yeah. So it's just a series of these waves. The market, takes the staircase up, as most people hear, and then the elevator down, right? So it's just a matter of understanding how the markets move. And if you look at these moving averages, which is the 150 period, the 50, the 20, and the 5, they're all fanning and sloping up. That's a very good sign. When you zoom out on the charts and you look at the big picture, it is starting to look a little, parabolic in terms of the price action when things start to go straight up. But there's nothing you can do about it. When something's in a strong trend, you gotta ride the trend until it proves otherwise. And who knows where this peak will be in gold once this wave kind of comes to an end. Yeah, so we've been trading and we're long currently the Sprott Gold Fund, PHYS. We've traded that a couple of times. We're long it right now. Let me just pull that up. So, yeah, I mean, obviously, there's a lot of stories out there about some of the other physical gold ETFs. Do they have the gold? All that stuff. And I mean, I trust Sprott. Sprott's, one of the most trusted names. So this is what we play. We've played this. We've had a couple very nice moves in playing these breakouts and these runs, these explosive moves using PHYS. And that's obviously my ETF of choice. I store my physical metals with Sprott, so it's kind of an easy solution. Just kind of one does it all. One kind of core name and brand there.
This rally is not confined to North American traders or ETF flows. Demand for physical precious metals is rising globally, particularly in regions where financial instruments are limited or mistrusted. Gold and silver are increasingly treated as monetary assets rather than speculative trades. Their relatively small market size amplifies price movement once capital flows accelerate. This explains why metals can move faster than equities despite fewer participants. As inflation risks, currency instability, and geopolitical uncertainty persist, physical ownership has become more attractive. In this environment, metals respond less to headlines and more to long-term capital preservation needs, creating sustained upward pressure.
Yeah, we move around. When we take a look at our hot list, I generally like to follow the GDX. GDX is kind of the one that I track. We can move around to trade different ones, but GDX is kind of the one that we track in terms of, I like to follow the larger caps because it gives me a better view of the tide of big money flows, bigger companies. I like to know if the tide is moving up or down. That's how we follow assets in the market. If something's trending higher, the large group of them, then we tend to follow that. So that is GDX is the barometer to track. And then from there, we just go and we trade whichever ETF or individual gold stock we would want to trade. But when we look at it, miners really have really just broken out of the highs that we saw back in October, and they have had a nice move, about a 30% move up from the lows, but overall they're not extending and ripping higher. You would think with gold hitting all-time highs and silver screaming higher, we would be seeing the miners moving up quite significantly, and they're really not. And I think it's a little bit more of kind of what you and I have talked about for many months, is I think the metal space is kind of where the global money's flowing. So from, a lot of countries can't trade in the US, or people can't buy ETFs, and depending on where you are. So we're seeing people just buy the physical. And I think that's, where the big money is. Not so much in the speculative side right now. I think we're seeing silver really break out and run because it's a small market and it's a global market. But the miners, I mean, they're still trending higher. I think they're getting ready for another pop and another run. I think we need to see gold break out and have a move higher. And I think that'll bring the miners back into high gear. When we look at this chart, I mean, we've seen this pullback. It's now kind of come up here and has created this kind of volatile pause. And I think it's primed and ready for a fairly significant run to the upside. And it's the same with silver miners. When we look at silver miners, we have much of the same type of pattern. SILJ, they move faster percentage-wise, so it's higher on the list, but it's the same. It's just had a very nice pullback. In fact, the pullback is what I call like an ABC pullback. You have an A, then you have a B, which is a bounce, and then the C. And the C pullback, it breaks the previous low. That's what creates a shakeout. Anybody who's following it too closely will have a stop set under there. And of course, they get shaken out, which you can see the market flush down with big volume, and then boom, it takes off and rallies. And it's the C wave, this ABC correction, that cleanses the air or the market, and then it goes higher. We even had the same, when you look at a lot of these patterns, the same thing happens. You have an A, you have a B, and then a C. And it's this little breakdown that shakes people out, and then the market screams higher. And it did the same right over here. A, B, C. Now, this one didn't break by much, but it still made a lower low. It would have flushed the market out, and then it takes off. So we just had that, and now silver miners are starting to run. Gold miners are starting to run. So I think we're on the cusp of, a breakout to some highs for SILJ and for GDX pretty much any day here.
Despite sharp pullbacks and headline-driven volatility, gold's broader trend remains constructive. Margin adjustments and regulatory changes have caused sudden sell-offs, but these events typically reflect forced liquidation rather than weakening fundamentals. When leverage is reduced, prices temporarily fall, only to stabilize once selling pressure fades. This pattern has repeated across previous bull markets. From a structural perspective, gold continues to form higher ranges and stronger bases. If momentum rebuilds, another acceleration phase could unfold. Rather than predicting a final peak, disciplined investors monitor each advance as it develops, recognizing that strong trends often last longer than expected.
Yeah, so 2026, for some reason, my charting is a little freezing up here. But 2026, I think we're going to see the equities market put in a significant high. I mean, I've been talking about that for a while. I think the surge in precious metals, if we see precious metals really scream higher here, and the equities market struggles, I think that's a bearish sign. Now, there's kind of a little bit of a strategy that people keep an eye on, which is the monthly chart of the S&P 500. If it closes positive the January month, then we usually have a positive year for stocks. If we close negative, it's usually going to be a negative year for stocks. So I always like to follow that, and I like to get a gauge of how that goes. January, from a seasonality standpoint, is generally a pretty volatile time in the market. If we look at the seasonality chart, you can see here, January, we usually see the market chop around and it becomes, pretty trendless. And sometimes it can have a little bit of a rally into the end of the year, end of the month. So right now we're in this little bit of a choppy month. People are trying to get a gauge on where is the market going and all of that stuff. A lot of my analysis, as you and I have covered, I believe overall, the majority of stocks in the stock market are showing signs that we're in a stage 3. We're very sector rotation, sector driven. What's hot one month is not the next, other than precious metals. We are coming into this phase where precious metals are dominating. Energy stocks are still trading up near all-time highs. Capital industrial goods are trading high. These are usually what come to life near a major market top. And of course, when we look at where we are, the innovation, which is AI this time around, has been dragging the indices higher. And I feel like it's starting to lose some of its steam. I think a huge chunk of investors who have been moving into the space out want to be part of the infrastructure and the data centers and AI in general. We've seen that huge influx. And now we're starting to see banks and private equity firms starting to tighten up. They're not giving out funding, as much funding for all of this AI stuff, because it feels like it's been a bit of a feeding frenzy. Things are overvalued, and that's starting to come to an end. And that usually, this innovation phase, once it fizzles out, which is just starting to show signs, it's also near stock market top. And then we're going to start to go off a cliff. And the economic data, as you know, is usually a quarter behind when we get quarterly information and GDP and all that stuff. Yep. So the stock market tops, everything starts to top out first, and then the market starts to get weaker, which is good for gold. We should see precious metals move up. But then, 1 or 2 quarters later, which is 3 to 6 months later, the bad news actually hits, going, oh, we're in a contraction. We're starting to see things slow. So that's kind of where I think we are in these major cycles. And these are, decade-long cycles or longer. So they do take a long time to change direction. And one of the other charts, which I don't think you and I have touched on before, is this this Benner cycle, right?
Oh, that's what that is.
So Samuel Benner, he's got these short-term cycles and longer-term cycles. The tech bubble in 2000, we had the 2007 financial crash, the peak there. COVID, 2019, 2020. And the next cycle high is this year, 2026. And it says we should be seeing weakness until 2032.
Oof.
So we're in for, all of my analysis has been pointing to a major cycle coming to an end. The question is, when does it actually stall and roll over? And this Benner cycle, not saying it's going to happen, but it's definitely nice to have to see something confirming that this could be the year that things really turn around. And the whole pop and rally in precious metals, to me, is one of the biggest warning signs. And when you look at all the other analysis of stage analysis and what sectors are hot, all of that stuff, and the whole AI, the innovation phase, everything is lining up that when this bubble or this rally, this bull market peaks, it's going to go into a devastating wipeout for most people who aren't holding the right assets, or they're holding assets that are going down. They don't know when to get out. So that's what I focus on, is not only avoid these market crashes, but benefit from them. And so that's, that's the core trick. And,
Yep.
one of the biggest things here is, I'm not sure if you and I have touched on this before, but this was last year. This is the February and April tariff crash. And everybody's like, oh my gosh, it's this time's different. This is, huge sell off. This isn't like normal. The crazy part is when you overlay that with the bottom chart, which is COVID, 5 years ago, they're almost identical. The market doesn't care what the news is. The stock prices are either being bought or sold. The stock market doesn't know why somebody's hitting the buy button or why they're hitting the sell button. It's just fear and greed. When people are selling, it goes down. And so that's what I track, is how to identify when a true trend has changed direction, when to get out, how to benefit from it. And so I believe we're in a similar situation as 2007, 2008, where stocks will start to weaken. Money will come out of the stock market and it'll pile into precious metals even more and create this blow off phase, which I think we're just starting to see this month. So again, all the signs are there for a massive market top, a life-changing event, whether it's for the best or the worst. It really depends on your skill set, the knowledge, the tools you have to identify and be able to navigate these markets, because we could see a pretty devastating correction, right? Going forward, like a lot of people were hammered with this little baby bear market of 2022. And we could come back and we could break those lows. We could see the market have a huge, huge correction. And, there's a pretty simple way to look at this market, as you and I have touched on it. I believe if you can understand what the equities markets are doing, you can navigate the rest of the markets, like precious metals and things like that. They kind of feed off each other. But we had the COVID crash. You need to know when to get out. You need to know when we're in a bull market. You need to know when we're in a bearish market. You need to know when we're in a bull market. We had the tariff crash, which kind of reset things. We're still in a bull market, but it's not a really strong bull market. It's not like all sectors are screaming to all-time highs or anything like that. It's really still AI has brought the markets up to where they are now. There's done all the heavy lifting. Now AI is actually stalling out. And I think we're going to start to see some big selling in stocks, which is going to probably feed the precious metal space.
Beyond individual markets, broader cycles are coming into focus. Equity leadership has narrowed, innovation-driven growth has slowed, and defensive sectors are gaining prominence, conditions often seen near major market peaks. Long-term economic indicators typically lag asset prices, meaning stress emerges in markets before appearing in official data. Historical cycle models, including multi-decade frameworks, suggest the coming years could bring increased instability. In such transitions, capital often abandons risk and concentrates in tangible stores of value. The acceleration in precious metals may be less about speculation and more about preparation for a global shift already underway.